Good day. My name is Marshall Abbott. I am the CEO of Aero Exploration Corp. We are a very strong value proposition in the Columbian oil and gas basins. I've got 35 years of experience in building companies and selling them successfully. We came into this particular opportunity 2 years ago. And as I said, the value proposition is quite material and real. And we're looking forward to exploiting this asset in what is one of the premier fiscal regimes in the world, as well as, from a geological setting, one of the more attractive technical prospects in the world.
Marshall, thanks very much for that introduction. We've not met or spoken before. Keen to hear your story. I always try to start with understanding the guest and what their relevant experience is. So you said you had some success in the past. Can you kind of talk us through that and why it's relevant to what you've got here today?
Sure. So I was educated in Canada, in Calgary. My family's been in the oil business since 1949. I have started, bought and sold 8 different entities, both domestically and internationally, all for profit. That is the way we operate. I've got a very solid core group of partners. We've done this together over the passage of time recently. Most recently, I sold an oil asset in Canada to a Cambodian casino billionaire who was looking for diversity in his particular asset mix. And we sold that for a significant profit. 2 days later, we moved to Colombia.
I think I know him. I did some work for him. Small world. Naga?
Yes.
There you go. I did some work for him. I did not know that. Right, there we go. Okay, so you've been able to make money with these projects. Obviously, it's been a difficult time in oil and gas for the last few years. I think a lot of retail investors looking in have avoided it, but prices are back up, deals are being done, and I think people are looking at this again. So I want to understand what it is that you've got, and we'll talk about those projects in a sec in Colombia and Canada. With regards to the rest of the team, have you kind of brought the band along with you, or have you sort of walked into a situation?
So it's a bit of both. I brought a band with me of trusted partners, and we were brought in to resurrect or pull an entity out of the ashes that has suffered through 7 years of commodity price collapse. And so we like the opportunity. We've cleaned it up considerably. It's taken a bunch of effort, but we have a very strong balance sheet and a very healthy prospect portfolio that is very low risk. And as we proceed through the low risk exploitation of the asset, we will then pivot to low risk exploration by shooting very focused 3D seismic programs, which is the key in Colombia. 3D has really opened up the basin. You want to know the highest point of the structure. 2D data won't do that for you, but we do have a very significant 2D grid, and with the leads that we developed and defined on the 2D grid, we're going to then shoot 3D, and that increases your chance of success beyond 80%.
Okay, well, I promise we'll allow you to get technical in a second there, because I think it's going to be critical to the conversation. But if I'm looking at your portfolio now, there's the construct that you kind of got inherited a Canadian asset, not too shabby a postcode either, or zip code, I think you guys say. And then there's the kind of Columbian. You've kind of got the sweet and the heavy there. So I want to talk about those in a second. So, I'm sort of keen to understand how because it's a small company, right? You're sort of sub 50 million market cap, right? And so the decision making down here is very, very important. Every dollar spent is really, really important. Every dollar raised is really, really important. And the cost of that is important. So with regards to the portfolio, you're making some choices about how you play it. So can we talk about what are you going to do with the Canadian asset?
So the Canadian asset is a very interesting asset, and it is occupied by really the most sought after play in Western Canada, which is called the Montney, the Triassic Montney. We have 36 square miles of Montney freehold mineral rights. On that, we have a CPR of 1.8 TCF gas initially in place. So it's a very resource-rich part of the basin. And to actually build that kind of land base now would be almost impossible because of the popularity of the play, the robust gas prices that are enjoyed in Western Canada, and the liquids that come out with that particular asset. We have inherited 2 wells that were drilled onto it. They go down to 10,000 feet and then horizontally for up to 2 miles. They're $8 to $10 million wells, but the gas and the liquids comes out fast. We are not going to do any of that drilling ourselves. We're looking at optionality on that particular asset, either to farm it out to some of the regional players or to monetize the asset, which we think will be successful in. We would then use that cash flow and focus it on the Columbian assets that have a much higher rate of return and very comparable reserves from an oil perspective.
Okay, so that's quite interesting. So you're looking to bring someone else in there because, I mean, why is that? Why not go and do it yourself? Is it the distraction of raising capital to be able to go and do it? Is it the cost of the drilling and likelihood of success, or why are you sort of putting that to the side, as it were?
Well, when we rank our prospects, our opportunities, it doesn't rise to the top. And so we're looking for capital efficiency, low finding costs, recycle ratio that makes sense. And although there's quite a bit of gas in place, it's going to take a bit of effort, quite a considerable amount of effort to get that into PDP volumes.
Right, but you don't need to do this because when you're a sort of distressed seller, there's a massive discount. If you need to do something within a time frame, there's always going to be a massive discount. In this instance, you don't mind whether you flip it entirely or you retain some kind of carried interest in it, knowing that the likely cash flow is much further down the line. So you don't have a preference per se.
Well, it's a very good point that we're patient. We have tenure. Those lands are going to be preserved for the next 5 years. So from the perspective of pursuing that play and trying to offset or pause our Columbian development effort, it's just not as efficient.
Okay, understood. I think it's always important just to kind of lay out the stall clearly so people know what they're walking into as investors. Okay, so let's bounce down to Columbia. How did you pick up the assets there? You've got 2 assets.
So the assets were picked up initially in 2018, 2019. These assets were a spin-off of the oil assets of a company called Canacol, which is a Canadian company that is the largest natural gas producer in Colombia. They own 20% of the company. They have significant gravitas in country. And we are dealing with some of the concessions and blocks that they had managed to cobble together over the last 10 years. Their focus has been on natural gas, so they felt that starting a sidecar and exploiting the assets in the sidecar was a much more reasonable business plan. So that's the history of the blocks that we've got. The blocks are very prospective in the heart of the most prolific basins in Colombia. The fiscal regime is top tier worldwide, and the profitability is excellent. The tax regime is very positive. It's an English-Canadian model, so it makes life simple. They've had 80 years of production in these basins. Oil is a big component of the GDP of the country. It's important. So we look to exploit these assets that basically landed in our lap.
And it wasn't. I think was it Dave Winter was the GO on the Canacol?
That's right.
Yeah. Okay. Yeah. Involved in that. A lot of crossover in this interview. Right. So let's again just kind of keep it simple for folks. You've got sweet oil and you've got heavy. So again, with the heavy, what's the intent there?
So the heavy is a 10% working interest in a heavy oil field that is operated by a Chinese concern called Sinochem, one of the bigger Chinese companies in the world. I think they've got a market cap of 55 billion. They're getting out of the upstream business, but with a 10% working interest, we can't control our destiny there. That's about 200 barrels a day net to us. It's 9 to 11 API crude, very low viscosities, but it does produce without any kind of stimulation. However, there is a steam flood ongoing. We see much better use of capital in other stuff. We're going to put that back to Sinochem and focus our efforts on the Llanos Basin and the Middle Magdalena Basin in Colombia. And much more conventional.
Much more conventional, better netbacks, etc. But so just on the number side of things. So what's that worth to you in terms of the cash flows or potential offloading? What would that bring into the company?
So on today's Brent prices, that would bring likely $2 to $4 million into the company.
Okay, so it's not significant in that sense, and possibly even a distraction. But that as a lump sum would be quite useful with you kind of the core focus. So why don't we look at what you want to focus on? Let's start with the why. The economics look very good, but it's 1,400 barrels of BOE a day. So it's small now. What do you think the possibilities are? What are you excited about?
Well, on the assets we currently have in place, the lower risk of the spectrum of opportunity is pursuing these well-established plays in the Llanos Basin in Colombia. These wells cost about $2.4 million. When using a forecast production rate of 360 barrels a day net to us, these wells pay out in 6 to 7 months.
So 6 to 7 months, not 67 months, yeah?
Correct.
Got it. Okay.
Yes. Sorry. Poor diction.
Okay. So that's quick. Right.
It is quick. The service industry in Colombia is very robust. It's got history. The technical expertise in Colombia is fabulous. We have a very efficient 20-person office in Bogota. World headquarters is in Canada. So the technical abilities and the financial abilities of the crew that we've got is fantastic. The people are our strongest asset, of course. ESG is also very important to us in these basins. And just a small note of interest in the Llanos Basin, these reservoirs are charged by rainwater out of the Andes, so there's excellent pressure support. You ultimately recover much more crude on primary production because of the strength of those aquifers. And also because of that, there's no natural gas entrained in the system, so we're not flaring any gas. So that makes our ESG very positive. Our GHGs are very low. At the same time, we're showing excellent profitability by exploiting these reservoirs. They're very visible on 3D seismic. They're very visible when we use our downhole tools to measure the properties. And it's very straightforward in getting this oil out quickly and to market.
Right. And you are paid when?
So a very interesting point. As we produce into our existing production facilities. We get paid a month in advance by another Canadian entity that operates in country. They use our crude as a diluent. And so we enjoy Brent pricing less a $2 to $4 differential called the Vasconia differential. As I mentioned, they pay us a month in advance, and we have a true up every 30 days. So there's no risk in getting our pipeline or getting our product all the way to the Caribbean refineries that exist in Colombia.
Fantastic. And the net back is plus $50.
Correct.
Right. Okay.
Yes.
So that's pretty punchy. 6 to 7 months payback on this. So that all looks quite good. So I guess the challenge ahead, or the narrative ahead, which you will want to talk about, I'm sure, is how do you scale this thing up quickly, given that economics look like they do?
Well, that's a very good question. So if we just focus in on the Tapir block in the Llanos Basin, the Tapir block is 100 square miles. The fault trends that penetrate that block are very recognizable. There's 6 separate fault trends. We're focusing on one initially. A second one towards the end of the year. These fault blocks are well defined by 3D seismic, 80% chance of success that they're filled with oil when you have 3-way closure up against a fault. So it's very straightforward. It's a play type that's been pursued for the last 30 years in Colombia, and 3D seismic has really opened it up.
Okay, so tell me, this is really important because that success rate, and so that hit rate is critical, is key here. And I'd also like to understand the decline rates as part of your answer, which is, so it's been people operated that model for the last 30 years. You guys are. The great thing about oil is we judge you almost on a daily basis in terms of like you're either hitting the numbers or you're not, and you're replenishing or you're not. So what are the kind of OpEx costs around the kind of drill planning component, if you know what I mean? So not how quickly do the drills pay back, but in terms of this 3D component, any seismic that you're doing, how much does that cost? And
well, that's a good question. So there was existing 3D seismic on the block that was held both by Canacol and other portions of 3D were submitted to the government as part of the work commitment. The work commitment has been entirely satisfied in the Tapir block, so that's not an issue. But from an operating standpoint, if we just look at lifting costs, currently in the Tapir block, we're at about $15 a barrel. As we add volumes, that's going to come down, in our estimation, to $9 or $10 a barrel. So from an operating standpoint, it's very straightforward, one of the most efficient reservoirs I've dealt with, and just addressing the decline issue. So these wells come on very strong. As I mentioned, they're supported by an aquifer that comes out of the Andes, rainwater charged. And as we produce these, they typically produce 90 to 120 days water-free, and then the water shows up. So you have to be able to handle that water. We dispose of the water in disposal wells, and that keeps our operating costs from getting any lower than about $9 a barrel. But the water is quite fresh, which is very surprising, and the ability to deal with it efficiently certainly adds to the bottom line. These wells will then decline at about 20% per year.
Okay, it's not bad. So again, it's sweet. So I guess you've no problem selling it. You're selling it at the wellhead. You're making good margin. So come back to the question around how do you scale this thing up? How do you finance the scaling of this? Right, because you've got, well, what's your land package at the moment, and what do you know about it?
So in the Tapir block, it's 100 square miles, and on the assets that we've recognized and identified in the Tapir block, we think we'll be able to get to 3,000 barrels a day in 15 months. And that's exploiting both the RCE production base. We have existing production at RCE. We are intending to drill spud the first well March 15th, approximately. The wells take 2 weeks to drill, another 2 weeks to production test. We use very high volume submersible pumps to get the commodity out quickly. And so just within the Tapir block itself on RCE, and then a subsequent fault trend called Carrizales Norte, we see very low risk getting us to 3,000 barrels a day. On the bulk of our blocks within Columbia, we see line of sight to 10,000 barrels a day in 3 to 4 years.
But how do you do that? How do you pay? Do you do that from cash flows, in which case the money's going back in the ground, or do you go out to market and say, "Hey, we know what we're doing now. We've cleaned up the portfolio and we're focused on this"? Do you go and raise a big chunk of change and say, "Right, we can really hammer this out quickly"?
So from the initial development drilling that we're going to do at RCE and ultimately at Carrizales Norte, we're fully financed. So we're fully funded. The balance sheet is strong. The share price is through the issue price, which is very positive. And so we see no need in the near term having to come back to the market to raise more equity. I think as we start to approach that 3,000 barrel a day number, we'll look at what other options there are on funding more aggressively. Certainly reserve-based lending we'd look at. We are and have the ability to access reserve-based lending. Debt can be your friend for sure. We're very sensitive to debt. And ultimately, as we approach 3,000 barrels a day on our way to 10,000 barrels a day over the next 2 to 3 years, we would look at becoming a dividend issuer, ultimately looking at all options. Another thing that is available to us within the Columbian basins, some of these bigger companies are focusing on much bigger prospects, and they're looking to decant assets. We'll certainly be in the market to look at these acquisition opportunities. So we have a multi-pronged focus on building the company to 10,000 barrels a day.
That's the fascinating bit for me, and that's where I also wonder about your strategy, the aggressive intent of your strategy. So you're good for cash, don't need to go out and raise money, self-funding, great. But with the decanting of these projects, the majors are under a lot of pressure. They're under pressure from activist investors, from the funds themselves, to either clean up their act or offload or reduce the dependency on oil and gas on their balance sheet, as it were. There's big opportunities here. So if you found yourself in a position where you saw a project of a size which would allow you to scale meaningfully, are you averse to actually going to the capital markets or whatever structured finance that you can have put in place?
We're certainly not adverse. The key component there would be to ensure that it's accretive. And so from that perspective, a combination of debt and equity would give us the best multiple expansion possibility. And with the prospectivity that we see in the basin and some of these very large companies moving their assets, it's really how we've made our living over the past number of years, is combining low risk drilling with acquisition opportunities and taking advantage of that market. We look at assets, and if we know that we can ultimately double or triple the production out of that asset, then we'll be very aggressive in picking it up, and that makes it far more accretive point forward. So we're not into it for just buying production for the sake of production. We're looking to optimize and be more efficient.
Okay, efficient is the key word. Coming back to the Columbia itself, Colombian government, obviously oil and gas is a significant part of its economy, its exports. What are the terms under which you work? I mean, what are the royalty rates like? What restrictions are there? It can't all be a bed of roses. And how do you get your money out of the country?
Good question. So as a bit of background, oil and gas is 30% of the exports of the country. It's very important to the country, and it's been well recognized. At one point, Colombia was producing 1 million barrels a day. It's been reduced to about 750,000 barrels a day. They have a mandate to get back to 1 million barrels a day. On the concessions that we hold, our royalty is approximately 10%. It can vary between 8 and 12. And we have significant tax pools and losses that will protect us, protect our income for the foreseeable future. So from a fiscal regime perspective, it is in the top decile worldwide of being one of the more attractive basins to operate in.
Okay. And just want to talk to you about blue sky opportunities, right? You talk in the presentation, some of the releases about Oso Pardo as a significant part of your future strategy. So what can you tell me about that?
Well, Oso Pardo is a very, very interesting asset. It's got 3 wells producing on it right now. We do have a proprietary 3D that exists over the asset. We have technically defined a much larger oil accumulation than was originally thought based on our analysis. We are forecasting no additional production coming out of there. We've had 2 separate independent studies done on the Oso Pardo asset. We have applied for a block extension that will encompass the entire oil accumulation that we see. These block extensions do have precedent. We're the only company to have the 3D. We have existing production. So we see the potential in Oso Pardo to add upwards of 3,500 to 4,000 barrels a day of production. Again, it's sweet like crude, comes out fast, and these wells are very cheap at 3,000 feet. And they pay out in 3 to 4 months. So it's an exciting opportunity for us, and we're just weaving our way through the regulators' bureaucracy to get the extension approved.
Bureaucracy everywhere, isn't there? This is another Canacol project, is it?
That's correct.
Got it.
Canacol drilled a discovery well.
Got it. Okay.
And then 2 subsequent wells. Those wells have produced far more oil than was originally conceived if you just applied a volumetric factor to them. There's a bigger asset in place here. The pressures have not dropped. The 3D shows the trapping mechanism. It's quite visible, and we assess it at being very low risk.
Okay. And other operators in the basin?
Middle Mag Basin is probably the second most prolific in Colombia. All the bigger names are operating in the Middle Magdalena. Just as a point of interest, in the most recent bid round, Perex, which is one of the more successful independents in country at 45,000 barrels a day, surrounded our blocks in the bid round by picking up additional blocks. So that's, I think, in itself indicates the prospectivity of the assets that we have in place right now.
It does. Okay, so what are we looking forward to in 2022? You obviously had a good end to last year and into this. You're fully financed, so it's a question of just wait for the drill results, is it?
That's right. So, as I mentioned, the first well will be drilled in the middle of March. 2 weeks to drill it, another 2 weeks to production test it. Likely 4 separate hydrocarbon-bearing horizons on the way down to 10,000 feet. We have offsetting production that proves up the concept, so it's very low risk. We'll drill an initial well, followed by a second well, followed by a third well, and then we'll go back to the initial well, the RCE1 well. There are 3 zones that have not been exploited in that particular wellbore, and we'll get that production up. So just based on the Tapir block alone, we're going to get a long ways to where our exit rates are forecast.
So what do you know about these horizons at the moment? So what's I know you talked about it being up against a fault is something that you're looking for, but can you just give us a little bit more technical about how you understand it?
Sure. So the fault trends are the trapping mechanism, and compressional tectonics have created these domal features juxtaposed against the faults. The initial well drilled, RCE1, penetrated 4 separate hydrocarbon-bearing zones down to 10,000 feet. They chose the shallowest zone to complete at that time, and that particular zone came on at 750 barrels a day. But based on downhole logging results and the mud logger gas chromatograph, we've identified, and it's been rather well accepted technically by independent bodies, that there are 3 other zones that are hydrocarbon bearing on the way down to 10,000 feet. So we're looking to exploit that asset a little more aggressively. In Colombia, you are able in some instances to commingle 2 separate reservoirs into one wellbore. We'll be looking to do that to ensure that we're not spending too much capital exploiting the asset. So from the perspective of producing efficiently and quickly, that's how we prefer to operate.
Okay, and are you experiencing any issues in terms of supply chain issues in country? Obviously, you're producing and et cetera, and we've talked to lots of companies about just in time versus having backups. And what's it like operating in country from that perspective?
Well, a very good question. So as I mentioned, the service sector is very robust in Colombia. All the bigger names are recognizable there: Schlumberger, Baker Hughes, Precision Drilling. We had no issues in retaining a rig that's going to drill up the entire program. All the supporting materials that we require are in place. We've got drilling mud. An interesting side point was the tubulars that are required, the steel that we are utilizing to case this series of wells. There's a worldwide shortage of steel right now. But because of the connections we have with our nationals in country, we've been able to establish basically a constant feed of casing and tubulars that will ensure there's no delays in getting this production on stream.
Good. Okay. No, it's important part of the discussion to understand, because you talk about efficiencies. You need efficiencies across the board, and sometimes those small things can make such a big difference in terms of timing. So, well, I've enjoyed that conversation. I've certainly learned a lot more about how you're going about it, and I can sort of I'm keen to stay in touch and see how you get on with this drilling. So appreciate your time today. Thank you, Marshall.
Well, I certainly appreciate your interest and your rather in-depth knowledge of how things work in this business. Again, we appreciate your time. I look forward to continuing the narrative.